Everyone. Sorry for the late start. Went out and saw another Warriors game last night, and yes, another L. They were leading most of the game but lost. Anyways, got home late, slept in a little bit, but still do what I do: get up, drink my coffee, and look at what's going on in the business world. So, first and foremost, we got to talk about housing, right? This is a real estate channel. Really, the intention of this is for me to really track what's going on in housing as well as the consumer, because again, I treat the consumer as my number one competitor. And first off, and home prices, it looks like they are accelerating. If you look at the Case-Shiller index, we came in at 3.2%. This again nationally, off of last month at 3.1%. The reason this is at least interesting to look at is we were on a decelerating trend for much of the last year. And, we had seen pretty good growth in prices. They had then started to drop or at least collapse, right? They were 5%, 4%, 3%. Now they're ticking upwards. And really what you see in there is really a mismatch between demand and price points. What I mean by that is the lower end is still very, very active, right? Think below the median. Think 50% of the median, right? There's just not a lot of inventory there, and what inventory there is getting snapped up, both by owner occupants, cash buyers, things of that nature. And then you have properties 2x the median that are not moving. They're seeing a drastic slowdown. The good news is, if you've been following this channel, we've been talking about that for, probably most of our daily updates. So they are seeing that. The only city or county or metro, whatever you want to call it, in the Case-Shiller to see a drop was San Francisco. Came in with a 0.7% drop. Again, if you've been following this channel, that's probably not a surprise to you. I have been talking about the Bay Area, which generally speaking, San Francisco is part of that, being in trouble. It frankly got unaffordable. And you layer on top of that other non-friendly things going on in California. It's no wonder there's a lot of companies leaving. I just read that when Charles Schwab bought TD Ameritrade, which we've talked about a couple of times on this channel, one of the things that's going to happen is Schwab is going to move its headquarters to Dallas from California. So there's going to be more and more companies that decide to do that, and that's going to hurt the Bay Area for some time to come. It's not a very friendly place for businesses, very high taxed. In San Francisco specifically, there's a huge homeless problem, and there's very rich and very poor, and there's really the middle class has been crushed. And frankly, it's better to live somewhere else if you're in the middle. So I expect this supply price imbalance nationally to keep going, and I expect San Francisco to show negative months for quite a while, I think. Next up, Dallas Fed president came out and said that he expects Q4 to be weak. I thought that was interesting. Just last week, we talked about a couple of, like, the New York Fed and one other, I want to say Atlanta, kind of talked about seeing Q4 being weak, kind of below 0.5% weak, but still growth, but still weak. Now Dallas president's coming out. So I thought it was interesting. If you really digged into why, he wasn't looking at the consumer, right? The consumer's fine, and we'll talk about that in a minute. He was saying that businesses were consciously reducing inventory. And, he suspected that would be at least 0.5 point or 0.5% reduction in the quarter, which is quite significant, right? Even if you're targeting 2%, to lose a quarter of that to inventory cuts is interesting. I really think what this shows is, the business environment has been weak for some time. Much of that around the negative kind of environment around the world. That's going to continue. I really think this is just another sign that China and the U.S. got to get a trade war, agreement done, even just for the headline, right? Just to show businesses that there is there's a light at the end of the tunnel. This has been going on almost a year, if not more. So it's pretty interesting. And it would be nice to get that behind us, because again, I think 2020 is going to be fine. I think I came out yesterday, maybe the day before, saying, you know what, I don't see a recession next year. So pretty interesting. Next up, something about Fitbit. Remember we talked about Fitbit being bought by Google. Something I just read in the SEC filing is there was a mystery bidder, somebody that bid up Google. It'll be interesting to figure out who that is. I'm guessing Microsoft. Just a wild guess. It would have to be somebody with some pretty deep pockets to want to go up against Google. Basically, the bidding war took Google's first offer of $4.59 a share all the way to $7.35 a share. So what is that, like 40%, right? So Google was bid up 40% to buy an asset called Fitbit. Again, this is what's going to happen next year. More and more companies are going to take their stock, i.e. Charles Schwab buying TD Ameritrade, or Louis Vuitton buying Tiffany's for cash, or Google buying Fitbit for a mixture, I believe it was. This is going to continue to happen. Right? Companies are going to buy market share. They're going to buy technology. They're going to buy growth. That's what happens. That's really what aggressive monetary policy means, and that's also what some investors are going to be doing. So again, U.S. consumer confidence falls. I wish these numbers made sense, right? U.S. consumer confidence falls from 125.5 on an expectation of 126.6. How is anybody supposed to use those numbers to make anything, right? A lot of the numbers that I watch use 50 as a growth versus shrinking, reducing, which I think is okay. But all these numbers are just crazy. So what I do there is I just track what's the trend. And again, the U.S. consumer confidence is trending negative. I do believe this is leftover from all the noise in the system we had. Remember the GM strike and the trade war and all of these things. I think, again, the consumer is fine, as we will talk about in a minute. I expect the consumer confidence to rebound as we head into 2020, but it will be interesting. Next up is holiday sales. Looks like holiday sales, again, back to the consumer being okay, are expected to rise 4%, which is crazy. We're at year 11 of a boom or a bull market. And, holiday spending, consumers going out, dropping significant dollars on Christmas or the holidays, it's going to rise 4%. And that's not what you really see at the tail end. That's a pretty significant growth. In the end, I still think we're on some kind of glide path to some kind of trade war resolution, which will be a net positive for the world. I think the monetary policy, aka cheap money, is here to stay for 2020 at least. And the consumers are doing our part. We just need to get businesses doing theirs, and 2020 will be just fine. So that's what I got for you today. Again, watching home prices, I expect many articles on that. We'll probably talk about it tomorrow. San Francisco is negative. The consumer is fine. The Fed sees Q4 being weak. Fitbit had a mystery buyer competing with Google, and the U.S. consumer confidence falls in the month. So at the end of the day, that's what I got for you. Have a wonderful day. We will talk to you tomorrow. Take care.